All right, let's jump right into this. Welcome back to The Explainer. Today, we're unpacking one of the absolutely wildest financial rides in recent memory, the 2026 gold shock. I mean, if you've been tracking the markets at all, you already know that gold, humanity's oldest, most trusted asset, has behaved entirely unlike its usual stable self this year. So, today we're taking a purely data-driven journey to figure out exactly what happened, why it happened, and what the world's top financial minds say is coming next.
And that brings us straight to the central mystery we're solving today. How did the ultimate safe haven lose 20% of its value in just a matter of months? You know, gold is supposed to be the bedrock of your portfolio, right? The quiet anchor in a storm. Yet, in the first half of 2026, it acted a lot more like a volatile tech startup. To understand this modern financial mystery, we really have to dig into the raw data. Section 1. The 2026 Gold Shock. Let's look at the sheer scale of this unprecedented volatility. $5,595.42. That was gold's historic, frankly dizzying peak on January 29, 2026. The year kicked off with this incredibly strong bullish wave. And why? Well, investors were terrified of slowing global growth, they were sweating over persistent inflation, and they fully expected central banks to roll out super loose monetary policies. Demand for a safe haven just went through the roof, pushing the price to this massive record high. But then, the floor just fell out. By June 23rd, the price plummeted down to $4,084.26. That is a drop of nearly 20% from its January peak, and it was dropping incredibly fast. Actually, in just the month prior to this June low, it lost over 10% of its value alone. For everyday investors who bought at the top, thinking gold was a guaranteed safety net, this was a moment of sheer panic.
Just look at this timeline. January 29th, we hit that peak. Then from February through May, this massive correction just sweeps the market. Why the sudden U-turn? Expectations shifted overnight. Suddenly, interest rate hikes looked way more aggressive than we thought. Inflation fears cooled off a bit because of weaker oil prices, and the US dollar surged. By June 23rd, we hit that 4,084 mark. It was a complete reversal of fortune. But to really grasp why this 2026 panic matters so much, and why we humans react so strongly to the price of this specific metal, we need to zoom out for a second.
Section 2. Gold through history. Civilization and economy. See, we have this deep-rooted psychological and economic connection to gold. It's not just another commodity, it's practically a foundation of human civilization. In ancient Egypt, it was the sacred metal of the pharaohs. Fast forward to the Middle Ages, the Islamic golden dinar became an incredibly stable global currency, the literal lifeblood of international trade. In 1848, the California gold rush completely rewrote the demographics of North America. But the modern era, that really kicks off in 1971, when U.S. President Richard Nixon ended the Bretton Woods system, decoupling the U.S. dollar from gold, which was fixed at just $35 an ounce at the time. Ever since then, gold's price has floated freely, paving the way for the massive valuations and wild volatility we see today. So who's actually controlling the flow of new gold today? China leads the pack globally, mining 380 tons annually, followed pretty closely by Australia at 310 tons and Russia at 300 tons. And keep in mind, getting this stuff out of the ground is no joke. It requires immense resources, massive water usage, and sometimes hazardous chemicals like cyanide and mercury, which makes environmental sustainability a huge hurdle for the modern mining industry. But here's the kicker. While countries like China and Australia mine the most new gold, the United States is still sitting on the largest historical stockpile, holding a staggering 8,133 tons, largely locked away in Fort Knox and New York. This proves a really crucial point. Even in our modern era of digital money and fiat currency, physical gold remains an incredibly vital geopolitical asset for the world's superpowers. All right, with that context, let's zoom right back into 2026. Section 3. Modern Market Drivers. Macroeconomic Forces. So what are the macroeconomic gears actually turning behind the scenes to cause these wild price swings? The first major driver is the classic inverse relationship between interest rates and gold demand. In the summer of 2026, markets priced in 68% probability that the Federal Reserve would hike rates in September. Now here is the golden rule of gold. It yields no interest. It doesn't pay a dividend. So when interest rates on things like government bonds go up, those investments look a lot more attractive. Consequently, demand for gold drops, pulling the price down with it.
The second massive driver, the US dollar. There's a direct inverse relationship here too. Because gold is priced in US dollars on the global market, a really strong dollar makes gold way more expensive for anyone buying it with a foreign currency. In early to mid-2026, the dollar showed significant strength, and that suppressed global demand for gold, dragging prices down even further.
But, it wasn't just rates and the dollar. A couple of very specific 2026 market pressures collided all at once. First, we had that sharp crash in U.S. tech stocks. When investors take a huge hit in stocks, they often get hit with margin calls, forcing them to liquidate their winning assets, like gold, just to cover their losses. Second, on the geopolitical front, the U.S. granted Iran a 60-day oil license. Purely from a market perspective, this really eased fears about global oil supply shortages. And when geopolitical fear drops, gold loses some of that safe haven premium. All of this just slammed into the market simultaneously. So that explains the crash. But what happens next?
Section 4. Future Forecasts. Where are we heading?
Let's look at the highly anticipated predictions from the world's leading financial institutions for the end of 2026. Right now, there's a massive divide on Wall Street. You have the bulls, like JP Morgan and UBS, projecting prices rocketing right back up to $6,000 or even $6,300 by year's end. Deutsche Bank is right there with them at $6,000. But then you have the bears. Goldman Sachs lowered their forecast to $4,900. And platforms like CoinCodex, they're predicting a severe drop, projecting a conservative slide all the way down to a range of about $2,800 to $4,200. It is honestly incredibly rare to see this wide of a divergence among top experts.
So, let's break down the assumptions driving these totally polar opposite predictions. The bullish case relies on a few key things. They're assuming the US dollar will eventually weaken, that the Fed will back off on huge rate hikes, and most importantly, that institutional demand will remain incredibly strong. The bearish case assumes the exact opposite. They believe the Fed is going to hike rates sharply, the dollar will stay completely dominant, and that global geopolitical crises will largely resolve themselves, basically wiping out the need for a safe haven.
But there is one massive factor propping up that bullish argument. Listen to this projection from JP Morgan. Central banks are expected to purchase 800 tons of gold in 2026. I mean, that is staggering. Nations all around the world are actively diversifying their reserves away from the US dollar. When central banks are buying 800 tons of physical gold, it creates a massive structural floor for the price. They aren't day trading, they're buying for the long haul. So how do we translate all of this high-level macroeconomic theory into reality?
Section 5. Investment Strategies. Practical Application.
How should a focused investor actually handle this? Regardless of the 2026 market chaos we just talked about, financial experts still universally recommend a baseline allocation of gold to hedge against currency devaluation and inflation. It really just depends on your personal risk profile. A conservative investor might hold 10 to 15% of their portfolio in gold. A moderate investor, maybe 5 to 10%, and an aggressive growth-focused investor might only hold 2 to 5%. The key takeaway here is that it's just a piece of the puzzle, not the entire picture. And if you are going to allocate, how do you actually do it? There are really three primary methods. Number one, physical bullion, bars or coins. The big pro is that you have real, tangible ownership. The con, high storage and insurance costs. Number two, ETFs or exchange-traded funds. These offer incredibly high liquidity. You can just buy and sell them like a regular stock, but you will have to pay management fees. And number three, mining stocks. These offer higher potential returns if the company strikes it rich, but they come with significant operational, environmental, and corporate risks. All right, to summarize our deep dive today, here are your essential takeaways from all this data. First, view gold as a long-term inflation hedge, definitely not a get-rich-quick scheme. Second, avoid overreacting to the kind of wild daily volatility we saw in 2026. Third, remember that institutional investors often view massive corrections, like that 20% drop we analyzed today, as buying opportunities rather than the end of a cycle. And finally, if you want to understand gold's price, you have to track the fundamentals. Keep your eyes firmly glued to the Federal Reserve's interest rates and the strength of the US dollar. Which really leaves us with one final, provocative thought to ponder. Will gold reclaim its $5,500 throne in the coming years, driven by central banks and inflation? Or is a new economic era of high rates and digital assets leaving humanity's ancient safe haven in the dust? The data gives us the clues, but ultimately, the market's going to decide. Thank you so much for joining me on this explainer today. Keep learning, keep your eyes on the data, and I'll see you next time.